Yes, so I think we were able to look at what is branch accounting. Also, we looked at the purposes of branch accounting and the types of branches we can actually be able to have. So we talked about, in this case, some organizations or some companies can have what we call branches. So they can operate with a model whereby, in this case, they have a head office. They have a head office. They can operate with a model whereby they have a head office with what you're calling branches. So you can have branches. So maybe you can have branch 1, so branch 2, branch 2. We can have maybe branch 3, so branch 3. So we can have a situation whereby, for example, these branches could end up having to depend upon their supply of goods from the head office. So it means some goods are actually transferred to the branches. Then these branches, there can be a situation whereby, for example, the accounting activities are done at the head office. Or sometimes we can have a branch whereby now, in this case, independently, it is able to, for example, undertake its accounting functions. It is able to source goods from the head office, but still the same case, it can be able to source goods by itself. So in a situation whereby we have branches, there are people who are not on mute here. Yeah, so in a situation where we have branches, we can have these branches having to independently undertake their accounting, or all the accounting can actually be undertaken at the head office. And as a result of this, then we end up having to have like a number of types of branches, which we looked at already. We said you can be able to have what we call dependent branches. We can have what we call independent branches, or we can end up having to have what we call foreign branches. Foreign branches. So in this case, our syllabus actually basically calls upon us to focus on these ones, but we'll be able to focus on how you account for these ones. So when you talk about dependent branches, they depend on the head office in terms of, for example, supply of goods. So they're not actually completely independent in terms of their activities, but independent, they're actually independent. And therefore, in this case, they can even be able to set up their own accounting function. They can be able to source for their goods independently without having to rely upon the head office having to do make the supplies of the goods. So we were supposed to look at now the journal entries that will actually be involved, where we have a situation whereby we have operations regarding a head office and, of course, a branch. We have operations regarding now a head office and actually a branch. So we are supposed to look at, in this case, the journal entries that you'll end up having to pass, the journal entries that you'll actually end up having to pass. My internet is unstable. My internet is unstable. What about right now? Is it any better? Is it any better? What about right now? Is it any better? I can see T says it is okay. I can see T says it is okay. T says it is okay. T says it. I don't know what about the others. So we want to look at the journal entries now in this case, that will likely end up having to be passed. I think we had looked at the ledger accounts that will likely be maintained. We said in this case, we'll have the branch inventory or stock account. We'll have the branch markup account. We have the goods sent to the branch account. You have the branch debtors account amongst the accounts that will likely be maintained. But now in this case, the journal entries for different kind of transactions. For example, we can have a situation whereby now in this case, goods have been sent to the branch. So if goods sent to the branch, how do you end up having to account for this? So if you have a situation whereby goods have actually been sent to the branch, how do you account for this? So in this case, you'll debit the branch inventory account, debit branch inventory account, We can call it inventory or stock account. Stock account. In this case, you debit it with the invoice amount. Invoice amount, you debit it with the invoice amount. Invoice amount. So that invoice that actually came from the head office. You basically debit the branch inventory account with the invoice amount, invoice price, or maybe the invoice amount. Then in this case, you credit. There'll be a markup account that you'll end up having to create. So I can still see you people are still complaining. The board is blurred. What about there? Is the board any better? Is the board any better? Is the board any better? I can see you're saying clear now. So clear now. So hope it is clear. The board is clear. So you're having to say with the goods sent to the branch, you'll be able to debit the branch inventory or stock account to the invoice price. But in this case, these goods that will actually be sent into the branch, they'll be at the invoice price. So there'll be the profit element in it. So therefore, in this case, it means you'll be able to credit the goods sent to branch. There'll be another account will maintain goods sent to branch account. Goods sent to branch account. Goods sent to branch account. This one will actually be at cost. At cost, will be at cost. Then the profit element, you'll be able to credit it in the branch markup account. So branch markup account. Branch markup account. In this case, you'll basically be looking at the profit element. The profit element. So when you add the profit plus this, you get the invoice price. So that's how you'll be able to end up having to deal with the goods that have actually been sent to the branch. So you'll debit the branch inventory stock account, then the credit the goods sent to the branch account, then there'll be a branch markup account. Remember in the ledger accounts, we said we'll be able to maintain for the branch. There's one account there we indicated, there'll be the branch markup account that will be able to maintain. So you'll be able to recognize the profit elements of the goods that are having to be sent to the branch. What is the profit element in it? It'll basically be passed through, in this case, the branch markup account. Then in this case, you have the goods returned to the head office. Sometimes these goods that have been sent can be returned. So goods returned to head office. Goods returned to head office. Office by the branch. So you'll do the opposite. So you just do the reverse. You'll debit the goods sent to branch. You'll debit goods sent to branch. You'll debit the goods sent to branch account. This one will actually be at cost. Then you debit the branch markup account. So the branch markup account that recognizes the profit element in those goods. Branch markup account. This one will actually be the profits on those goods. Then in this case, you credit this one. You do the opposite, branch inventory. You credit the branch inventory account. You credit the branch inventory account. So that is transaction number 2 that can end up having to occur. Then transaction number 3, sales made by the branch. So if the branch makes a sale, so sales made by the branch, what do you do? Made by the branch. So if the branch makes a sale, this one can actually be in cash form, or it can be maybe a check. So in this case, it means you'll be able to debit cash. You'll debit cash or bank. You'll debit cash or bank. It can be either cash or maybe bank, or in this case, it can be credit sales. So that means you'll end up having to have a debtor having been created. So you'll debit the debtors account. Then in this case, you credit the branch stock account. It will reduce the branch, you credit the branch. It will reduce the branch stock account. Branch inventory account will reduce. Inventory account. Then inventory, we're having to maintain that the branch will reduce because the sale has actually been made at the branch. So you'll end up having to credit the branch inventory account. Then in this case, you would have made a sale. Maybe it can be in cash form, or it was via check, or it was a credit sale. So in this case, it will create what? A data account there. And then in this case, the returns of goods by the branch customer. Returns of goods. There can be returns of goods. So these goods are having to be sold by the branch to their customers. The customers can be able to end up having to return these goods to the branch. Either they can return at the branch, or they can end up having to go to the head office. So they want to see the people at the head office. They return to the head office instead of having to go to what? To the branch. So what happens if he had sold to a customer, then he ends up having to return these goods to the branch. So return of goods by a branch customer, return of goods by a branch customer, return of goods by a branch customer. In this case, you'll debit the branch stock account. So the inventory will increase, which they had sold. Debit branch stock account. Remember, they had made a sale, but now it means that the goods have been returned. So the inventory is increasing, which is an asset. When assets increase, you always do what? In this case, you debit. You always debit. So you'll end up having to debit the branch stock account. And then in this case, credit. Remember, if you had actually sold on credit, you'll end up having to credit what? So you'll end up having to credit the debtors account. You'll credit the debtors account. Or for example, in this case, if you end up having to do a refund, in this case, a customer can be able to return the goods, then he can end up having to ask for you for a refund. It means you'll end up having to reduce your cash. It can reduce your cash, or it can reduce your amount at the bank. So they can ask for a refund. If it was not a sale on credit, it means that they can ask for a refund. If they ask for a refund, you will return the money which you had received here when you made the sale. Then it can happen that in this case, these goods have not actually been returned by the customer to the branch. They have returned at the head office. So they have returned the goods where? At the head office. They have returned the goods at the head office. So what happens if they end up having to return the goods at the head office? So they can be the returns of the goods by the customer and not the branch. So they have not actually gone to the branch. They decided, let's take the goods to the head office of this company. So goods returned by the branch customer to the head office. So what happens? Goods returned by a customer, a branch customer, by a branch customer. Goods returned by a branch customer to the head office. To the head office. So they don't go to the branch, but then in this case, they go to the head office. If this is the case, then you debit the goods sent to the branch account. So you debit the goods sent. You debit the goods sent to branch account. Goods sent to branch account. Goods sent to branch account. This one will likely be at cost. Will be actually at cost. Then you debit. So you debit the branch markup, the profit element. You debit the branch markup accounts. In this case, you'll basically, be dealing with the profit element in these goods that have actually been returned. Then you'll credit now, in this case, the branch debtors account. So the branch debtors account. You credit the branch debtors account. You'll credit the branch debtors account. You credit the branch debtors account. So in this case, it'll be like, if you look at, for example, number 2, is like a return that has actually been made by these goods by the branch to the head office. You can see, for example, what you're having to do in number 2. Whenever, for example, the branch returns the goods to the head office, we debit what the goods sent to the branch account. And we debit what? The branch markup account. But in this case, the goods were supposed to be returned to the branch. It's only that in this case, they have been returned to the head office. It's like the goods for the branch are going to the head office. So you debit the goods sent to the branch, like what is happening in number 2. If you can look at number 2, your entries that we've said in number 2, you debit the branch markup account. But now in this case, it will be reducing the debtors. It won't actually be reducing the inventory of the branch at the branch level. But of course, it will be reducing what the debtors. The overall debtors of the branch will actually be reduced. So in this case, you credit the branch debtors account, Then transaction number 6 that could end up having to occur, could actually end up having to occur. Sometimes the goods can actually be stolen. So goods stolen in the branch. Goods stolen in the branch. Maybe it can be by the employees. Goods stolen in the branch. Goods stolen in the branch. Goods stolen in the branch. This one quite obviously in this case does what? Reduces the inventory there at the branch. It actually reduces the inventory there at the branch. But now in this case, it will end up having to create what? An expense. There'll be an expense having to be incurred because you have to cater for these goods stolen. Unless maybe you end up having to recover this money from the person who's having to steal, which won't be easy. It will basically automatically be an expense having to be incurred. So it will actually be expensed through now in this case, the profits and loss account as what? As an expense, because you'll end up having to incur it as a company. If you would have sold these goods, maybe you would have made a profit on them, but you can't sell them. So the cost that you bought the goods, you have to incur by yourself as a company. So you'll debit the goods stolen account, which will automatically be an expense in the income statement. So debit the goods stolen, stolen account, debit the goods stolen account. In this case, we're having to say it will end up having to affect what? The loss account, the P&L account, This one, you'll be able to do it at what? At cost. You'll do it at cost. But now in this case, the goods that had actually been sent at the branch will end up having to do what? End up having to reduce. So in this case, you'll credit the branch stock account. You credit the branch stock account. It is reducing the inventory at the branch. So a labor to the inventory there, which is an asset, will end up having to reduce. So an assets reduce, you credit. So you credit the branch stock account because it will be reducing this person. Maybe it was an employee there who stole. So the goods at the branch have actually been reduced. But of course, it is an expense that will actually be incurred for that particular branch. So you'll debit as an expense in the P&L account. Then there can be a situation whereby, for example, also cash has actually been stolen. So, in this case, in the branches, maybe you have cashiers. You can be having a company whereby, in this case, you're operating what? Branches. So in this case, it means if there's cash that has actually been stolen, so cash can be stolen, you can have cash, they steal from the till, cash sales stolen from the till. Cash sales stolen from the till. So this one, how do you deal with it? Automatically here, it is having to reduce your cash because in this case, you had made a cash sale, but in this case, it has actually done what? It has actually reduced. So cash sales stolen from the branch. So in this case, you'll debit the cash stolen account, 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 then in this case, simply because this one will actually basically be part of the inventory you would have ended up having to sell. So these sales that you've actually ended up having to lose in terms of you failing, not having to be able to sell, it means that in this case, this would have actually basically been part of the inventory you are supposed to have been able to sell at the branch. So it means you won't be able to realize it as a sale from the stock. So you'll end up having to credit, you'll credit the branch, you credit the branch stock account. You'll basically reduce this amount from the branch stock account that you're having to sell. So you'll credit the branch stock account. Then there can be an increase in price. Another transaction. The branch can decide in this case, they're going to increase the price of the goods. So they are selling goods there at the branch, but now in that branch, they have decided they'll change the price. So there can be an increase in price in the branch. Increase in price in the branch, increase in price of goods in the branch, increase in price in the goods in the branch, automatically this one will end up having to affect what the markup account or the profit account. So the profit element will likely be affected. In this case, you debit, what you'll do, you will debit that profit element, you debit the branch stock account, you debit the branch stock account with the profit elements as a result of the increase. Then in this case, you credit the markup account. So when the profit increases, you'll end up having to credit the markup account. You credit the markup account. And of course, you're going to see in this case how you eventually, in this case, for example, end up having to create these accounts. Then the very, very last one, there can be a transfer of goods from one branch to another. So there are a number of branches. So they are like, for example, 10 branches. Then it happens that maybe branch A has transferred goods to branch B. Or maybe in this case, some goods have actually been transferred from a particular branch to the other. So in this case, there'll be those accounts of the receiving branch having to be affected, and the branch that is having to send out the goods will likely also be affected. So if you have two branches, then there's one branch having to receive maybe the goods that are having to be transferred. There's another one having to do what? Lose the goods that are having to be transferred. So there'll be, in this case, the accounts of the two branches having to be affected. And these are basically, you'll end up having to deal with it. For example, if there's a transfer of goods from branch A to branch B. So there'll be the receiving branch and the branch that is having to send the goods. There'll be the receiving branch and there'll be the branch that is having to send the goods. So in this case, if there's a transfer of goods, the last one, the last journal entry, if there's a transfer of goods, transfer of goods from one branch to the other. Transfer of goods from one branch to another branch, one branch to another branch, one branch to another branch. Remember, it is not from the head office to the branch or the branch to the head office. But now these are branches between themselves. They're having to transfer goods amongst themselves. So in the books of the receiving branch, what will you do? Books of the receiving branch. In the books of the receiving branch, here, the branch that is having to receive these goods, you'll end up having to debit the branch stock account because the inventory of this branch will be increasing. Debit branch stock account or inventory account. Stock account. In this case, it will be at the invoice price of these goods. Invoice price of these goods. It will be at the invoice price of these goods. Then in this case, you'll credit branch markup account. You'll credit the branch markup account, credit the branch markup account, the branch markup account. Then in the books of the selling branch, the other branch that is sending out the goods, books of the selling branch. In the books of the selling branch, in this case, you'll debit branch markup account, debit this branch markup account, the branch markup account, because it will be losing these goods. So it won't be able to enjoy this profit. So it will basically lose this kind of a profit to the other branch. Then in this case, you'll credit the branch stock account. So because the stock for this branch will be reducing, you credit this branch, the branch stock account. You credit the branch stock account. This branch that is sending out, this could be branch A, this could be branch B. So they are members of the same company, So it means for branch B, these are, when you are preparing the branch accounts for this branch, these are, you'll be able to treat this kind of, for example, a sale to the other branch. So you debit the branch, this branch B, there's a markup account it is maintaining. Remember, each and every branch is maintaining its own accounts. The ones we are talking about here are for each and every branch. So for this branch in its accounts, we'll be able to, in this case, ensure that if it is selling out to another branch, you've debited the branch markup account, and of course, you created the branch stock account. Remember, in this case, there are those specific ledger accounts we say they'll likely be maintained by a branch. If you can be able to recall them when you're having to, for example, final in the previous class, we listed them. We said we can be able to have the branch inventory, goods sent to the branch, we can have the branch markup, we can have the branch debtors account having to be maintained. And therefore, in this case, for each and every branch also, we can be able to come up with an income statement, statement. So these are basically the ledger journal entries you'll be able to pass if you come across a number of transactions regarding what operations of different branches. So now in this case, we can be able to look at an illustration. Therefore, in this case, we see how eventually you can actually end up having to create these ledger accounts, how you'll pass the entries, and of course, in this case, eventually how you can end up having to generate an income statement for a branch, an income statement for a branch. So you'll be able to write an illustration. So someone wants me to elaborate on transaction number 7. Number 7 is which one? 1, 2, 3, 4, 5, 6, 7. So cash sales stolen. So I think cash sales stolen, we've been able to say you'll debit the cash stolen account. You'll debit cash sales stolen. So cash sales stolen. We've been able to say in this case, you'll debit the cash stolen account. Then in this case, you'll end up having to credit the inventory account. You'll end up having to credit the branch inventory account. So this one, the cash stolen here, you are having to say in this case, you'll expense it. It will be like now, it will become like now in this case, what? An expense in the P&L for this branch, because they will incur it as an expense. So this money was actually stolen. So it is the money that they'll be able to incur as a business, as a branch by themselves. So it will be an expense. But now in this case, remember they are cash sales. These were supposed to be sales. This was supposed to be what? To be sales. So it means that in this case, probably this actually, or obviously, this is actually basically out of the inventory that was actually supposed to be sold. So really, it was not actually sold. It was actually like a lost inventory. It was like a lost inventory because the money they were supposed to realize out of this inventory by having to sell was actually lost. So in this case, it means that part of the inventory here was actually lost. It was not actually really sold because they didn't actually, for example, realize what this sells from the inventory. So of course, it is an inventory that has gone out, but it's like a wasted inventory. They haven't been able to realize cash from this inventory through the sale. So it will basically, in this case, affect that branch inventory. It will affect the branch inventory because this inventory, actually, they would have been able to sell it. They actually sold it, but they lost the money. So it's like they lost that inventory because they didn't actually realize the money from this inventory that actually went out as a sale. So it will basically, in this case, reduce the branch inventory account. And overall, in this case, if it reduces the branch inventory account here, it will end up having to do affect what in this case, for example, you'll end up having to present in terms of the opening stock or the closing stock in the P&L account. So that's basically how in this case, you'll likely end up having to account for for this particular kind of a loss, this kind of a loss. That's why you're having to say in this case, you reduce the branch inventory account. So we can look at an illustration. So just begin with what is going to happen so that you can be able to understand. Once you understand the illustration, then I think you can be able to get to know how you can deal with branch accounts or independent branches accounts. So we can look at an illustration. So I'll be able to present it here. Very fast. You can be able to write it. It is a very short illustration. You can be able to present. I can be able to present it here. So you can be able to write. So you can be able to write. So illustration. You can be able to write illustration. So XYZ Limited. XYZ Limited deals in electronics goods. Deals in electronic goods. Deals in electronic goods. Deals in electronic goods. The head office is in Nairobi. The head office is in Nairobi. Is in Nairobi and has branches all over the country. And has branches all over the country. And has branches all over the country. All over the country. All purchases are made at the head office. All purchases are made at the head office. All purchases are made at the head office. And the goods are charged to branches. And then what happens? And the goods are charged. And the goods are charged to branches. And the goods are charged to branches. At cost plus. Or in this case, what they mean by cost plus here, there's a cost, then they put a markup. At a markup of, in this case, 25%. 25%. So the head office buys the goods. So they buy the goods. Then of course, now in this, mark them up to the branch at 25%. So if the head office buys at 100 shillings, then in this case, they add 25 shillings. So they send to the branches at a price of 125 shillings to the branches. So that's what the head office actually does. So that is basically what is actually happening there. So you'll be able to see how you deal up. There's that account you're talking about every time. The branch markup. I think you've seen, we mentioned it so many times. So now that's when in this case, this percentage comes to help us. You see how basically it actually helps us to come up with that account. We've really mentioned it so many times. So we eliminate the profit element by utilizing this one. And of course, you must actually be able to know, for example, how we convert this one into what we call a margin. And of course, you're going to see it. So you can just be able to finish up with the illustration, what it is having to say. The following information relates. The following information relates. The following information relates to the Nakuru branch. The following information relates to the Nakuru branch. So you can start with opening balances. Opening balances. That is at 1st of January 2017. 1st of January 2017. So these are the opening balances. So we have one of the opening balances they have for this year. It is the branch inventory account has a balance of branch inventory. This is at invoice price. The branch inventory at invoice price is 300,000. So 300,000. In this case, we have another opening balance of branch debtors. So the branch debtors. So the amount for the branch debtors, the opening balance at the start of the year was 450,000. I think you've seen us mentioning this account, the branch debtors account. You've seen mentioned. So they're having to say in our case, the opening balance by the start of the year for the branch debtors was 450,000. Then in this case, you have the closing balances for the year. Closing balances for this year. So that is by 31st of December. They had this kind of closing balances for these ledger accounts. So by 31st of December, they had closing balances for these accounts as follows. So we have in this case the branch inventory. So this branch inventory had a closing balance. branch inventory header closing balance. So this was at invoice price, at invoice price, the branch inventory closing balance by the end of the year was actually 250,000. 250,000, so like that. Then in this case, there are a number of transactions during this particular year that actually occurred. So transactions for the year, transactions for the year. So you have a number of transactions for the year. So the number of transactions for the year. So the first transaction we can be able to write there. Of course, I can see. The board is already full. So in this case, the goods sent by the head office to the branch. Goods sent by the head office. Goods sent by the head office to the branch. Goods sent by the head office to the branch. This was at invoice price. At invoice price. This was at invoice price. The amount is 2.5 million. 2.5 million. The amount is 2.5 million. So the goods sent by the head office to the branch at invoice price, it is 2.5 million. 2.5 million. So we have the branch inventory there. The invoice price is actually 250,000. We have in this case the branch debtors, that is 450,000. Then you have in this case the branch inventory, invoice price. At invoice price is 300,000. That is, those are the opening balances for these ledger accounts. Opening and closing balances for these ledger accounts. Then there is a transaction for the year, that is goods sent by the head office to the branch at invoice price. It was actually 2.5 million. 2.5 million. Then we have other transactions, like 7 of them, so you can be able to capture them. We have like 7 transactions before we start looking at the ledger accounts. We have like 7 transactions before we start looking at the ledger accounts. Other transactions, other transactions, other transactions. You continue with these transactions for the year. You continue with that. So the other like 7 transactions before we start looking at the ledger accounts. So the other transactions in this regard, goods returned by the branch. We have goods returned by the branch. There are some goods returned by the branch. Goods returned by the branch to the head office. To the head office. This was actually at invoice price. At invoice price. At invoice price. So the amount for this one is 200,000. So the branch in Nakuru returned some goods to the head office. 200,000, but of course there were some goods also sent from the head office to that branch in Nakuru. So there were cash sales which are actually made by the branch. In this case, it was actually 800,000. So they made some sales there at the branch. So it was 800,000. They made some also credit sales. There were credit sales which were made. Credit sales were made. So these were amounting to 2.7 million. 2.7 million. So they made credit sales of 2.7 million. 2.7 million. So there were returns from customers to the branch. So customers returned some goods to the branch. Returns from customers to the branch in Nakuru. From customers to the branch. Our branch in Nakuru, they sold to customers, but these customers ended up having to return to them some goods. So returns to customers to the branch, this was actually 100,000. It was actually 100,000. Then another transaction that actually occurred, so they allowed some discount to the credit sales. Discount allowed to the debtors. They allowed some discount to the debtors. So that means there was an amount of 30,000 that they allowed them as a discount. There was an amount of 30,000 which they actually allowed them as a discount. Then bad debts, there were some bad debts written off. So amongst the debtors they had, bad debts written off. So they wrote off some of these debtors. So they wrote off an amount of 20,000. So they wrote off an amount of 20,000. Then branch expenses. In that branch in Nakuru, they incurred some expenses. branch expenses. So that means if you are to come up with a P&L for the branch, this one you have to consider it as an expense for the branch. It will reduce the profit for the branch. So the branch expenses were 500,000. So they were 500,000. They were 500,000. Then I can see Dennis is saying he is not seeing. Dennis is saying, I don't know whether the others are able to see. Goods stolen at the branch. Goods stolen at the branch. The goods stolen at the branch. So it was an amount of 30,000. 30,000. Then cash sales stolen at the branch. Cash sales stolen at the branch. Cash sales stolen at the branch. So these cash sales which are actually stolen at the branch, they were not included in other sales. So they were not included in other sales. They were not included in other sales. So these cash stolen at the branch, which was not included in the sales, it was actually 15,000. So there was a cashier in Nakuru who was a crook. He stole 15,000. He made sales, then he stole 15,000 out of the sales. This cashier stole 15,000. Then the last transaction, cash received from branch debtors. Cash received from branch debtors. The last transaction, cash received from branch debtors. So the debtors paid. It means it will reduce the branch debtors. Remember, you have a balance of branch debtors at the start of the year. We have the opening balance and the closing balance. So in between hapo katikati, our debtors walilipa, kuna pesa walilipa. That's why at the end of it, we have that balance that you're having. But of course, be able to balance it and see what is the balancing figure. So it was 2,450,000. That is what the debtors paid during the year. So these are the transactions that actually occurred during the year. So we are therefore in this case called upon. We are called upon in this case the required. We have the required. So we have the required. What are we required to prepare? We have the required. We have the required. Required number one, the branch inventory account. Number one, they want you to prepare the branch inventory account. The branch inventory account. Number two, what they want you to prepare, it is the branch markup account. Branch markup account. Branch markup account. That is what they require you to prepare. We've mentioned it a number of times in our journals. So they want you to prepare that one, the branch markup account. Then also in this case, the goods sent to the branch. Remember, we also talked about this journal entry. So number three, what they require to prepare the goods sent to the branch. Goods sent to the branch account. The goods sent to the branch account. So number one, what they require to prepare is the branch inventory account. Number two, branch markup account. Then goods sent to the branch account. Then number four, the branch debtors account. Number four, they want you to prepare the branch debtors account. Branch debtors account. Then number five, the income statement. The income statement or the statement of P&L. The income statement. So these are the ledger accounts. In this case, they want you to end up having to prepare. So that is the required. That is what they required from that question we have. So you prepare the branch inventory account, the branch markup account, the goods sent to the branch account, the branch debtors account, and the income statement account. The income statement account. So hope you've been able to capture Dennis. Are we together, Dennis? Dennis is not able to see. I don't know whether the others are able to see and you've been able to capture the question. Just inform me whether you've been able to capture the question, because I want us to start passing the journal entries. I want us to start passing the journal entries, then eventually we come up with the income statement. I can see Naitale says clear. Then T says captured. T says captured. So hope in this case, the others have actually been able to capture. So because I want us to start preparing those ledger accounts so that you see in this case, those journals we've talked about, how do you pass them? How do you pass them and how do you eventually come up with the income statement for the branch? How do you eventually come up with the income statement for the branch? How do you eventually come up with the income statement for the branch, for the branch? Yeah, so there are those ledger accounts, which in this case we can just open them. We can just be able to open them. We can just be able to open them. So those ledger accounts, we can just be able to open them. So you have, in this case, they want us to prepare the branch inventory account. So you have the branch. The branch inventory, you have the branch inventory account. We have the branch inventory. Oh, there you are not able to see. You're not able to see. Sorry about that. So you have the branch inventory account. You have the branch inventory account. Then you have, in this case, the branch adjusted or markup account. The branch adjusted. We have the branch adjusted. So the adjustments here regarding inventory or goods sent to the branch, we do it here, or refer to it as branch markup account. The branch markup account. So we can have the branch markup. That is the number 2 which they have called upon us to prepare. Then in this case, we have the goods sent to the branch account. So you have the goods sent to the branch, account. So we can open it. So hope you're able to see it. So goods sent to the branch account, branch account. Then we can have the final one. In this case, the branch debtors account. They have also called upon us to be able to prepare the branch debtors account. The branch debtors account. The branch debtors account. Like that. So you have the branch inventory account, the branch adjusted branch or branch markup account, the goods sent to the branch, and then of course in this case we have the branch debtors account, So this branch inventory account, so we prepare it at the invoice price. Then in this case, we need to be able to deal with the profit element by having to pass the profit element through what you are calling what? This branch markup. Then these goods that are having to be sent at the branch, in this case, they have to be at cost. They have to be at cost. In this case, remember when you add the cost plus the profit, you eventually come up with what? The price or the invoice price. You come up with the invoice price. So just take note that in this case, this branch inventory account is prepared at the invoice price. So in the question, you'll probably in this case be told the invoice price or the goods were sent to the branch at a selling price of this, or that is the invoice price. So when you are basically passing entries here in the branch inventory account, anything affecting the branch inventory account, you have to recognize it at what? At invoice price. Then the profits element, because you have to adjust the profits elements for, in this case, the goods you're having to send to the branch, then you need to come up with the branch markup account, and you're going to see how you pass the entries. Then the goods sent to the branch, you'll basically be able to recognize them at cost. In fact, in this case, if you look at, I think, entry number 1 in the journal entries, you can be able to see somewhere you're having to say that in this case, you do what? You debit branch inventory, then you credit one of the portion of that amount in the branch markup, the other portion of that amount in the goods sent to the branch. So the goods sent to the branch is actually at cost, but when you remember, when you add the cost plus the profit element, you end up having to get what? The invoice price. You get the invoice price. So remember, our balancing figure here will basically, for example, tell us, so what was the gross profit? That's why in this case, you have to recognize what the profit element regarding the goods that have actually been sent to the branch. So we'll be able to see the gross profit by having to get the profit element in each and every goods that are having to be sent to what? To the branch. So we'll be able to get what? The gross profit as the balancing figure here eventually when you finalize on this kind of what? An account. So we can be able to start parsing the entry so that in this case, you can be able to see how eventually you'll come up with these what? Accounts, how you'll end up having to come up with these accounts. So the first entry they were having to be told, the opening balance, you can see the first up there on the question, the opening balance is actually how much? So the invoice price, the branch inventory, the opening balance for the branch inventory is actually 300,000. And of course, inventory will have a debit entry. So the opening balance brought down for inventory here, it is actually 300,000. You need to pass that entry, 300,000. Then also in this case, you're having to be told that the branch debtors balance brought down at the start of the year is actually 450,000. So you have the balance brought down. In this case, for the debtors is actually 450,000. 450,000. But now remember, in this case, we're having to say that this opening balance, so this particular opening balance here, it has what you are calling what? A profit element in it. It has what you're calling what? A profit element in it. And of course, in this case, you've been told the markup. You can see the markup. The markup is actually what? 25%. Is actually 25%. So in this case, the profit element here, we have to be able to pass it through now. In this case, what? The branch markup account. The branch markup account. And of course, this 25% is actually on what? On the goods sent to the branch, the goods sent to the branch. But now in this case, we have to recognize what? The profit element on in this what? Inventory, which is actually at what? At invoice price or the selling price. So therefore, in this case, you have to convert this one into what we are calling what? A margin. We have to convert this one into a margin. And of course, now in this case, you'll be able to take 25, because this one is 25% over 100%. It'll be 25% over 100% plus 25%. Or alternatively, in this case, if you do the math here, this one will likely be 1 out of, I think, 5 or something. 1 out of 5. This one is actually, markup is actually on the cost. And of course, now in this case, it is 25% over 100. So this one is actually what? A quarter. So you'll be told that in this case, if you want to convert now the markup to the margin, you have to take either the numerator or the denominator. I think the numerator you add on the denominator. So it will actually basically be 1 over 4 plus 1 to be able to convert it into what? On the to be a margin, because this is the selling price. And of course, the profit elements here, we can only be able to recognize it by having to use what? A margin. By using a margin. It's not actually on cost. So in this case, you have to recognize the profit element on this what? Opening inventory by having to pass the entry through what? In this case, the branch markup or the branch markup account or the branch adjusted what? Account. So therefore, we've been given the markup, which is actually 25%, but now we have to convert it to the margin because this is what? The selling price. So we normally recognize margin on the selling price. Margin on the selling price is actually basically profit over the sales. Markup is actually profit over the cost of sales. Is actually profit over the cost of sales. But now here, what we've been given is what? Is the selling price. So the profits element here, we can only be able to recognize it if we can be able to convert this markup to the margin, because for margin is profits over the sales. For markup is actually profits over what? The cost of sales. But we're not having to deal with the cost of sales here. We are dealing with what? The invoice price or the selling price. We convert this markup to the margin. As I've said, 25%, you take 25% of 100, it will be a quarter on the cost of sales. But now to convert the markup to the margin, we normally take the numerator, you add on the denominator, you get 1 out of 5. 1 out of 5. So that's basically, in this case, you convert what? The margin to the markup. Or we take now, in this case, 25% over 125. 25% over 100 and what? 25. So that's basically, in this case, you'll be able to get our what? Our margin to recognize the profit element now in what? In the inventory there. So it means that in this case, for our markup or adjusted markup here, we'll be able to have a balance brought down. So we'll be able to have a credit of a balance brought down. A credit of a balance brought down. In this case, you'll be able to take, already been able to convert, is actually a fifth. A fifth multiplied by this amount, which is actually 300,000. So it will be a balance brought down of 300,000. So in this case, you'll be able to get, I think, 60,000. You'll get 60,000. You'll be able to get the profit elements. We created the profit element in the adjusted markup account by taking a fifth, or you can take 25% over 125, as you've been able to do the math there. Then you multiply by the 300,000, you'll be able to get what? 60,000. You'll be able to get, in this case, 60,000. You'll be able to get 60,000. So that's what basically in this case, you'll be able to, in this case, adjust the profit element on what? On the balance brought down on this kind of what? Inventory. And then if you look at the closing inventory, the closing balance of the inventory, in this case, you've been told that the amount here is actually 250,000. So the balance brought down at the end of the period. Remember the balance carried down, sorry, not brought down, but carried down at the end of the period is how much? 250,000. Is actually 250,000. It is at the end of the year. Remember the start of the year tunaanzia huku juu, end of the year tunaweka huku mwisho. See huko mwisho, end of the year. There'll be other transactions coming here, which you're going to see. But now it is actually carried down at the end of the year. But of course, now in this case, we've already been able to say the profit element. So therefore, we come here, the balance carried down. Hope you're able to see there. Hope you're able to see there. Hope you're able to see there. So the balance carried down will likely, in this case, be a fifth multiplied by the 250,000. So you'll be able to multiply the a fifth by 200 and this one, 250, to be able to get the profit elements in the branch inventory at the end of the year. The profit element in the branch inventory at the end of the year. In this case, you'll end up having to get, if you multiply that, I think you'll be able to get 50,000. You should be able to get 50,000. So exactly 50,000. 50,000, exactly 50,000, 50,000, 50,000, exactly 50,000. So the balance carried down here, 250,000. A fifth of the 250,000 is exactly 50,000. So like that. So you would have been able to deal with what the opening balances, the opening balances. Then there are transactions which actually occurred. You're having to be told goods sent by the head office to the branch at invoice price was actually 2.5 million. Was actually 2.5 what? Million. And of course, in this case, we said whenever goods are sent to the branch, we do what? If you look at your entries, if you look at your journal entries, whenever goods are sent to the branch, what do we do? Maybe you can be able to look at the journal entries and try to tell me what we are supposed to do. Whenever goods are sent to the branch, we debit which account? If you look at our journal entries, whenever goods are sent to the branch, we debit the branch what? Stock account. So we debit the branch stock account. So we'll be able to debit here. So these goods sent to the branch, in this case, we'll be able to debit, this amount was actually how much? 2.5 million. So 2,500,000. I think 2,500,000. So you'll be able to debit the branch inventory here will be increasing. At the branch, they'll likely be increasing. So then in this case, you go to the goods that have actually been sent to the branch. The goods 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 sent to the branch, or alternatively here, we can first of all be able to eliminate the profit element here. So in this case, the profit element will likely be, in this case, goods sent to the branch, goods sent to the branch. And of course, we've already been able to determine exactly a fifth. So you'll be able to take a fifth of what? The 2.5 million, a fifth of the 2.5 million. If you can see there, they are indicating you credit this branch markup and you credit the goods sent to the branch. So in this case, you'll be able to take a fifth of this. It comes to how much? Is it 500,000? I think it is 500,000. 500,000. It means in our goods sent to the branch, we'll credit how much? It means in the goods sent to the branch, we'll credit how much? We'll credit how much? Remember, if you look at our entries, we've been able to say that you debit the branch inventory, you credit the branch markup with the profit element on these goods having to be sent to the branch. Then in this case, you also credit what? The goods sent to the branch. So for the goods sent to the branch, you'll be able to credit with how much? It will likely be 2 million. It will likely be 2 million. So therefore, in this case, you come into the goods sent to the branch, and therefore, in this case, you'll be able to credit with that amount of what? 2 million. So the branch stock here that was actually received, or the goods sent here, the branch stock, you can be able to say in this case 2.5 minus 0.5, which is here. So in this case, you'll be able to get what? 2 million. 2 million. And of course, you would have been able to complete that kind of what? An entry. Then goods returned by branch to the head office. So there were some goods which were actually, in this case, returned to the head office. So it means if we return some goods to the head office, our branch inventory was actually having to do what? Reduce. So automatically we reduce it. We credit that inventory by the goods returned. Goods returned to the head office. So it reduced our inventory at the branch. So in this case, it was how much? 200,000. It was actually, in this case, 200,000. There was an amount of 200,000 that had actually been returned. But in this case, you have to do what? Look at the profit element. So it will come this side. Look at the profit element there. It will basically be this side. So the goods returned. So we take a fifth. Remember, in this case, you've already been able to recognize the margin is actually a fifth. So we multiply by these goods that are having to be returned. It's actually 200,000. I think you'd be able to get, is it 40,000? Is it 40,000? Yes. 40,000. Then, of course, it will end up having to also affect the goods that had actually been sent to the branch. So the goods sent to the branch. So here we have returns to head office, returns to head office. You get the difference. You just get the difference. It will actually basically be 200,000 minus the 40,000 to finish up the double entry here. The goods that had actually been sent to the branch had actually basically, that account had actually been reduced because some of the goods were having to be returned to the head office. So in this case, you can be able to take the 200K, you take the 200,000, you minus 40. I think you minus 40, you'll be able to get 160,000. And of course, you would have been able to complete that kind of what? An entry with those kind of what? Returns. So those kind of returns. Then there were cash sales, which were actually made. So they made some kind of, in this case, what you're calling what? The cash sales. They made cash sales. So means maybe in this case, they received money through the bank or something. So it means if you make a sale, there at the branch, it will end up having to do what? Reduce your amount of inventory. So ukiuza ile inventory uko nayo hapo kwa branch, ita reduce. So in this case, you'll be able to have, in this case, what you're calling what? The cash sales here. There'll be the cash sales there, which will likely end up having to reduce the inventory at the branch. So that was how much? 800,000. So in this case, you'll end up having to, in this case, credit the inventory there, which is because it is reducing. But of course, you have to debit your cash or bank, But in this case, we haven't actually been called upon to prepare the cash or bank account. If in this case, we had the cash or bank account amongst the ones we are preparing, we would have been able to debit. Or for example, in this case, if you are ending up having to come up with a balance sheet, it means that we should be able to recognize there was an increase in terms of cash during this year. So this one will be able to affect what? The cash balance. But now we haven't been called upon to prepare what? The cash account. So there's no need of passing the other entry. So the double entry would have been, you credit this inventory account because it will eventually reduce the amount of inventory at the branch level. Then of course, now in this case, you end up having to do what? Debit the cash or the bank. You debit the cash or the bank. Then you're having to be told credit sales amounted to 2.7 million. So credit sales in this case amounted to 2.7 million. So they sold goods on credit. Whenever you sell goods on credit, it means that your debtors are doing what? Are increasing. But of course, the amount of stock or inventory you have there at the branch, itakuwa inapungua. So in this case, your debtors will likely automatically increase. So in this case, you have a credit sale, wale watu unadai wanaongezeka. So you have to increase your debtors. It was with how much? 2.7 million. 2.7 million. But of course, you've been able to say this credit sale will also be able to do what? Reduce your inventory there. So therefore, in this case, you'll also have to recognize the credit sales of the 2.7 million there. So the double entry will end up having to elapse like that. Kindly zoom. Goods sent to the branch account. Goods sent to the branch account. So there, hope you're able to see. I think there it's a bit better. Goods sent to the branch account. This one is actually 2 million. It's 2 million. So the difference we have in this case, the 500 plus the 2 million, then we have the 2.5. That's the double entry, how it is completed. So the 2.5 is on the debit side. On the credit side, you have the 500, which goes to the branch markup. I recognize the profit element in this, then we can actually be able to pass it like that. We can actually be able to pass it like that. So that is basically how, in this case, you'll be able to deal with, in this case, what the credit sales. Then you're having to be told returns from customers to the branch. So there are some returns that in this case were actually made by the customers to the branch. Returns from customers to the branch, it was how much? 100,000. 100,000. So these returns that were actually made by customers, it means they ended up having to do what? Reduce the debtors amount here. So the debtors amount here ended up having to do what? Ended up having to reduce. So there's that amount of 100,000, which will end up having to recognize as having to reduce what? The branch debtors account. So returns by debtors, returns inwards. So we have returns returns inwards of the sales which had actually been made, which will reduce the debtors. So kama ulikuwa umemuuzia then akakurudishia, inamaanisha deni yake inapungua as a debtor. So in this case, it was like an amount of, in this case, 100,000. It was an amount of 100,000, an amount of 100,000, an amount of 100,000. Because when they return to you, then your inventory actually increases. So they have, in this case, the returns in. When they return to you there at the branch, your inventory actually increases. So therefore, in this case, it is an amount of returns from debtors. These were returns from debtors. It was an amount of 100,000. So also your inventory increases. Ulikuwa umewauzia hii side ikatoka, but now sasa maybe ilikuwa kwa hizi, but sasa wamekurudishia. So zimerudi hapo kwa branch inventory hapo. But now them as debtors, ulikuwa na wadai 2.7, but lazima wapunguze. Sababu wamekurudishia. So they have returned. So those are the returns. So like that, the returns like that. Then in this case, discount allowed. Whenever in this case, for example, you had sold some goods to your customers, if you allow the discount, then in this case, it means you reduce the amount you are claiming from them. You reduce the amount you're having to claim from them. So therefore, in this case, the discount allowed here reduces your debtors amount. Discount allowed will reduce your debtors amount. And of course, the discount allowed here was actually how much? 30,000. Yes, 30,000. It was actually 30,000. But remember, the discount allowed here will actually be expensed in the P&L or the income statement. So it means when you'll actually be preparing the P&L account or the income statement, will debit this 30,000. So that's why the double entry will actually end up having to be completed. Or for example, in this case, if you are doing complete ledger accounts in the books of accounts, you'll open the discount allowed account and you debit that amount. But of course, it will be able to do what? Reduce your debtors amount. It will reduce your debtors amount. So you'll be able to recognize this one as an expense in the income statement. Then, so bad debts written off. So when you write off debtors, you reduce the debtors amount. So when debtors reduce, you credit. So bad debts written off. So they had to write off some debtors here. They had to write off some debtors here. So bad debts written off. Bad debts written off. It was an amount of, in this case, 20,000. I think it was actually 20,000. 20,000. It was an amount of 20,000. It was an amount of 20,000. An amount of 20,000. An amount of 20,000. So like that. So, and of course, this one will be what? An expense in the income statement. So remember, when you'll be preparing the income statement, we have to recognize these two as expenses. That way the double entry will be completed. It won't affect these accounts. It will go there in the P&L or the income statement. It will be debited there as an expense. It will be debited there as an expense. Then we have branch expenses. Those one will go to the income statement as an expense. Then you have the goods stolen at the branch. So there were some goods which are actually stolen at the branch. So it means that in this case, these goods will actually end up having to reduce what? The inventory at the branch. So in this case, when the goods at the branch are having to reduce, the inventory as an asset is reducing. When an asset reduces, you always credit. So goods stolen, kuna goods waliba. Goods stolen, they reduce the goods at the branch. So the goods stolen here were what of an amount of an invoice price of how much? 30,000. So these goods are actually basically stolen from the branch. So it was worth an amount of, in this case, how much? 30,000. Because these goods that are having to be stolen, there was a profit element in them. There was actually a profit element in them. So it means that we have to be able to pass it through what? This particular account. You have to pass it through this particular account. So the goods stolen here, goods stolen. So you take a fifth, multiply by the 30,000. I think you'll be able to get an amount of 6,000. 6,000. Remember, there's a difference of what? 24,000. So the 24,000 is on, in this case, we'll end up having to expense in the P&L. So when you prepare the P&L, we'll be able to expense that particular kind of what? An amount. That particular kind of an amount will likely end up having to expense it in the P&L account. In the P&L account. P&L account, it will basically be part of, now in this case, what? The cost of goods that are actually sold. You'll be able to expense it where? In the P&L account. So the 24,000 will debit it to the P&L account. But now the profit element on these goods that are actually stolen will be able to debit it in what? In the branch markup account. In the branch markup account. So like that. So a fifth. Remember, in this case, the profit margin on all the goods at the invoice price is actually at a fifth. So the fifth of the 30,000, we get what? The 6,000. Then the 24,000 that is actually remaining will complete the double entry in the P&L account, where we'll be able to recognize in this case how much? An expense of 24,000. An expense of 24,000. Then we have in this case cash sales stolen at the branch, which were not included in the sales. So there was some cash which was actually stolen at the branch, which were not actually included in the sales. And of course, we've been able to say that whenever, for example, you have some cash which was actually stolen, ideally, that was actually like part of inventory which was actually sold. You are supposed to realize that cash, but you never realize it. It's like in this case, you like lost what? Inventory there where? At the branch. So in this case, we said we'll be able to credit the branch inventory account with the cash stolen. So the cash stolen there, it was an amount of, in this case, 15,000. It was an amount of, in this case, how much? 15,000. It was an amount of, in this case, how much? 15,000. But now in this case, remember, when you likely be preparing, the P&L, when you basically be looking at the sales, this particular figure will end up having to affect in the P&L by reducing what? The sales figure. So it will end up having to, in this case, for example, in this case, it will affect the sales figure in the P&L account. It will likely affect the sales figure in the P&L account because you're having to be told that in this case, the cash sales stolen at the branch were not included in other sales, So of course, now in this case, we end up having to credit, but now I have to remember now in this case, we'll likely be coming up now in this case with the P&L account. This particular figure here of 15,000 will likely affect the amount of sales which are actually made in this particular branch. Then we have cash sales stolen, so that we've already been able to deal with this. Cash received from branch debtors. So there was some cash which was actually received from branch debtors. So it means that in this case, debtors actually ended up having to pay. So there was cash received of an amount of, in this case, 2,450,000. So 2,450,000. 2,450,000. It means that in this case, the debtor is reduced. But now in this case, if you are to prepare a bank account or a cash account, then we would have ended up having to do what? Debit the cash or a bank account with that amount. But now in this case, the credit entry basically reduces the branch debtors account. It reduces the branch debtors account. So those are the entries. So that is cash received from branch debtors. That was actually 2.450, 2.450, 2.450. So that's basically, in this case, you would be able to complete what? The entries. But now in this case, what is remaining is for us to be able to balance, this ledger account, ledger accounts. So now in this case, maybe you can be able to start with the branch debtors account. Let's start with the branch debtors account. So which side seems to be more? So this particular side seems to be more. I think it is 3150. 3150,000. So 3150,000. So the balance carried down. What is the balance carried down? So if that is 3150,000, what is the balance carried down? What is the balance carried down? You can give us the figure. You can give us the figure. So what is the balance? So the expenses, the branch expenses will go to the P&L account. They won't affect these accounts. It can't affect branch inventory. It won't affect the branch markup here. It won't affect the goods sent to the branch. It won't affect the branch debtors. So it go to the P&L account. Remember, our ledger account number 5 you are preparing, it is the income statement. So it will go there. It will go there. What is the balance carried down? Balance carried down you're having to get here for the branch debtors. So you're getting an amount of, I can see you're saying 550,000. So 550,000. So 550,000. 550,000. So 550,000. It is correct. It is actually correct. It is actually correct. It is actually correct. It is actually correct. So then in this case, you can be able to balance the goods sent to the branch. You can be able to balance the goods sent to the branch. So which side seems to be more? So this side seems to be more. Looks to me this side is actually more. So we have 2 million. Then in this case, we have 2 million. We have 2 million. We have 2 million. We have 2 million. So what you need to be able to realize here, it is that the balancing figure will likely end up having to get here. It will be the purchases by that branch. So in this case, the balancing figure, it will be the purchases for that branch. It will be the purchases for that branch. Remember, in this case, we're talking about what? Goods sent to the branch. So we want to know, for example, you want to recognize the profit for that branch. The purchases for that branch is what the head office was having to send to the branch. Remember, if the head office is selling, of course, the head office, it is a sell. But now to the branch, it is a purchase. It is actually what? A purchase. So therefore, in this case, the balancing figure here will be the purchases for the branch. Whenever they get the goods from the head office, those are their purchases. So in this case, for example, if they have to recognize what is their profit, if they want to know their purchases, they'll have to look at what does the head office suppliers, together with any other supply that we are doing by ourselves. All those ones they put together, they become what? Purchases. So the balancing figure in the goods sent to the branch will be the purchases for the branch. In this case, you're getting how much? I think 2 million minus this, you get 1840. 1840. 18. So that's what you have to realize or discover now. That's what you have to realize or discover now. That the balancing figure in the goods sent to the branch will be the purchases for that branch. Will be the purchases for that branch. So in this case, if they are coming up with a P&L for that branch, this balancing figure here in the goods sent to the branch will now be the purchases that in this case they acquired. Either, maybe in this case, they have purchases that are having to be sent as sales. Remember, when the head office sends the goods to the branch, that is like a sell to the head office. But to the branch, when they are receiving these sales from the head office, that is a purchase to them. So the goods sent to the branch here, the balancing figure here, will be the purchases to the branch, will be the purchases to the branch. So that will be 1840. 1840. Then we come now in this case to the branch inventory account. You can be able to balance this one. The branch inventory account. I think we have goods returned, cash sales, so debtors. So you have 200,000, 800,000, 2.7 million, so 30,000, so 15,000, then 250,000. So I think this side seems to be more. So what are you getting as the total here? What are you getting as the total here? So that side seems to be more. What are you getting as the total here? What are you getting as the total? This side seems to be more. What are you getting as the total there? I can see you're saying 399500. So 399500 like that. So 399500. So here you get a balancing figure. So the balancing figure for the branch inventory here will be the markup. It will be the markup. It will be what we refer to as what? As the markup. The markup. And of course, it will end up having to affect this one. But I want you to give me, first of all, the balancing figure. Balancing figure here. The balancing figure there, if you minus those ones, I think you'll get a figure of like, I think, is it 1095 or something? You get 1095,000. You'll get a figure of 1095,000. 1095,000. Then this markup, so this particular markup here, will actually basically, you'll credit it here. So you'll take this markup on this. Remember, this is basically the account that is basically recognizing what the markup on the branch inventory. So the balancing figure here will what has actually been marked up on the any exchanges in terms of what the branch inventory. So this branch, this markup here, which is the balancing figure here, you'll end up having to credit it. You pass the entry now, in this case, in the adjusted or the branch markup account. And therefore, in this case, you recognize this branch markup from the branch stock account. So that is 1095,000. 1095,000. Then you now balance this one. You balance that one. So when you balance that one, I think you'll be able to get that other side having to be more. And then now in this case, what you'll be able to get here in this markup, in this branch markup, will be the gross profit. Will be the gross profit for this branch. You'll get the gross profit for this branch. So what are you getting as the total there? What are you getting as the total? I hope you can be able to get a figure of like 1655? 1655000. So 1655000, like that. 1655000, like that. So 16500, like that. Then when you get the balancing figure there, you'll be able to get 155900, like that. It means when you come up with the income statement, your gross profit should be this one. If you get a different figure, your workings are wrong. It means in this case, when you end up having to, because you're going to prepare the income statement, when you come up with the income statement, the gross profit should be this figure. Because the balancing figure in the branch markup account is the gross profit for the branch. But if you get a different figure, inamaanisha kuna mahali umekosea in your workings. So you need to be able to, for example, check what could be the issue. So automatically, when you start having to prepare the income statement, when you take the sales minus the cost of sales, we should be able to get this one as the gross profit. So the balancing figure in the branch markup account is normally the gross profit that has actually been realized by that branch. But remember, here we have to carry the markup, what has actually been marked up on the inventory, which is the balancing figure in the branch. It means you have to balance this in branch inventory account first of all. Then you take the balancing figure, which will end up having to be the markup on the inventory for the branch, which you basically transfer in the branch markup account here. Then you balance. When you balance it, it should be able to give you the gross profits, which is actually what? 1559,000. 1559,000. So I can be able to see now in this case, you're having to say, it will still be the balancing figure, but you'll bring it this side. It will still be here, but you'll be able to bring it this side. So I can see you're saying, what if the credit side of the branch inventory was higher than the debits? But that is what has happened here. That is our situation. The credit side is more than the debit side. That is our situation here. I thought you were asking the reverse. What if the debit side is more than the credit side? It means the balancing figure won't be this side. It will be this side. Then, of course, you bring it here. You'll be able to bring this branch stock here. It won't be this side. You bring it here. Probably in this case, it can give you a gross loss, which will be this side. It will give you like a gross loss, which will actually basically be this side. So it will be the opposite having to occur. So if the balancing figure is here, you move it here. You complete the double entry by moving it here in the branch markup account. Then probably what will occur in that kind of a situation, we won't have a gross profit. We'll have a gross loss, Remember, here is on the debit side. So basically it means it will be on the credit side in the P&L account as what? As a gross profit. So that's basically, in this case, you come up with what? The branch inventory, the goods sent to the branch debtors, then of course the markup account here, which basically ends up having to recognize any profit element in the goods having to be sent to the branch, So this account is maintained at the selling price or at the invoice price. This is the profit element. Then of course, now in this case, these goods sent to the branch are maintained at cost. Are actually maintained at costs. at cost. So we can come up with the income statement. We can come up with the income statement, We can come up with the income statement. I can see we have 15 minutes. So there are those who are, you people are joining another class or what? I think you people might be joining another class and I'm not aware. We have 15 minutes. You people might be joining another class. So we can come up with the income statement. So the branch income statement. So XYZ branch income statement. It is for that year ended 31st of December 2017, 31st of December 2017. So most obviously, when you are doing an income statement, what do you start with? You start with the sales. Unaanzanga na sales. Unaanzanga na sales. Unaanzanga na sales. Huwa unaanza na sales. Huwa unaanza na sales hapo. So of course we can be able to check so the sales. So of course when you are looking at the computations, we are able to see there were two kind of sales. There are two kind of sales. We had cash, and of course we had what the credit sales. You can be able to recall very well. We have the credit sales, and of course in this case we had what the cash sales. So the cash sales, if you just look at the TO balance that we've actually been given there, the cash sales were actually in this case 800,000. Were actually 800,000. Were actually 800,000. But remember, so of course you can see, hope you can be able to see it. There's a cash sale that was actually made of 800,000. But remember, if you look at the second last item, we're having to be told cash sales stolen at the branch, not included in other sales. The cash sales were actually stolen at the branch, but were not actually included in what? In other sales. So you have to, in this case, do what? Recognize those sales, which had not actually been included. So it will be plus the 15,000. It will be plus the 15,000. In this case, the cash sales will actually end up having to be the ones that are supposed to be recognized, 815,000. Then also you have credit sales of 2,700,000. But remember, you're having to be told returns from customers. This returns from customers to the branch. Returns from customers to the branch. So these sales ended up having to be reduced by 100,000 because they made some kind of like returns of 100,000. So that basically comes to, is it 2.6? I think it is actually 2.6 million. 2,600,000. 2,600,000. Then, of course, you can be able to go to the cost of sales. So we less now the cost of sales. Cost of sales, you will start in this case with what you're calling what? The opening stock. The opening stock. The opening inventory. Remember the opening inventory here, we'll recognize it at cost. And of course, now in this case, to get the cost, we'll end up having to take, of course, the opening balance for the inventory is actually at 300 at the selling price or at the invoice price. But now in this case, to get it at cost, you have to reduce or less the profit element, which was actually 60. I think it was actually 60. You can see in the markup account, it was actually 60. We have to remove that element of the profit, which is actually 60. So the opening inventory there will actually end up having to be. So these are shillings. These are shillings. They are not cows. These are shillings. They are not cows. So they are shillings. So that is 240,000. Then, of course, there are purchases. You add purchases. You add purchases. You add purchases. Remember the purchases here. We've been able to balance that goods sent to the branch account. We've been able to get our purchases is actually 1840,000 from the goods sent to the branch. We've been able to get it as 1840,000. Then we need to be able to less what? The closing inventory. Less the closing inventory. So the closing inventory, we can less the closing inventory. We can less the closing inventory, which also in this case you have to recognize at cost. Remember, the closing inventory in the TO balance was actually 250,000. But remember, we've been able to remove the profit element there. if you look at now, in this case, our markup account there, it was actually how much? 50,000. So we need to less the 50,000. So we less the 50,000 from our markup account there because we are recognizing this particular inventory at cost. So 200,000. We need to less the closing stock, less the closing stock, less the closing stock. Then amongst these stocks, remember there were some goods which are actually stolen. There were some goods which are actually stolen. So remember, in this case, you're having to be told that goods stolen at the branch was actually how much? 30,000. So part of the inventory you are having to deal with here, kuna yenye iliibwa. So you have to reduce it. We have to reduce it. We have to reduce that inventory which was actually stolen. So in this case, the goods stolen. So the goods stolen. So the goods stolen. Also, it will actually be at cost. So remember, in this case, we had recognized the profit element as having to be how much? 6,000. But in this case, it will likely be 30 minus 6,000. So that will be 24,000. 24,000. So that should be able to give us what you're calling the cost of sales. The cost of sales. So how much are you having to get? Just try to add. Just try to add and actually less. So 240,000 plus 1840 minus 200 minus 24. Minus 24. What are you getting? Just try to add. So the opening stock plus purchases minus closing inventory minus goods stolen, because it is reducing part of that closing inventory there. Part of the inventory there. How much are you having to get? I can see 1856,000. So 1856,000. 1856,000. So this 1856,000, you must be able to less from this. If you add these two, then you less this one. What are you getting? If you add this and this, then you less this one. What are you getting? Joyce, if you add this and this, then you less this. What are you getting? You are getting, Hope is saying 1559. So you're getting 1559,000, which is actually what? The gross profit. Remember, there's somewhere we got our gross profit. And I told you that when we'll be coming up with what? When we'll be coming up with the income statement, it should be able to tally with what we got that other end under the markup account. So if the figures are different, then in a manager, if you're in an exam, you need to start doubting yourself. But now it doesn't mean you stop there. You need to continue because they mark what? Entries. So usifike hapo uone aingiani useme oh, hii exam imenikalia kunikalia. You need to continue because in the exam they mark what? Entries. They mark the entries. Don't stop there. So inaweza kuwa tu kuna kafiga kamoja umesahau. So you need to just continue. But in this case, you need to, like, after you finished up with question number 5, you go back and actually try to check why was it not having to tally. There must be an item, these funny adjustments that you're having to do here. I must have missed out on one of them. Maybe in this case, on the goods stolen, I haven't been able to, for example, remove the profit elements on it, or I haven't removed the 24,000 here. What have I done? You need to be able to check. So it has to tally with what is actually in the markup account. So that is the gross profit. Now in this case, you do what? You less on this gross profit the other expenses, which now in this case you haven't been able to recognize there. For example, in this case, we are now less what? The expenses, less other expenses which are there. The other expenses which are actually there. In this case, you have the branch expenses. The branch expenses, which is actually what? 5. You continue here. Usianze kuandika kando. I'm doing this because I can see you can't see it here. So I've moved here because you can see it. So you just continue. You less expenses from this gross profit. So the expenses here is actually how much? 500,000. The branch expenses is actually 500,000 from that to your balance. Then the other expense in this case we have is bad debt written off. I think we have bad debt written off. Bad debt written off is actually 20,000. Then you have in this case discount allowed. It is 30,000. I think it's 30,000. Another expense we have, there were some goods which were stolen. So there were some goods which were stolen. That is an expense the entity will end up having to incur. But of course, it will actually be at costs. It will be at cost. That is 24,000. Then in this case, we have cash stolen. Cash stolen. Still an expense they'll be able to incur by themselves. So 15,000. So you less these ones. You less all these ones. You less all these ones from this one. You less all these ones from that one. You should be able to get the net profit, branch net profit. The net profit for the branch. You should be able to get the net profit for the branch. You should be able to get the net profit for the branch. So how much are you having to get as the net profit? When you minus 1559, you minus all these ones because you less the expenses. Alternatively, you can be able to put them in this column. Then you total them. Then you less finally from this 1559. What are you having to get? What are you having to get? What are you having to get? I can see T says 970 thou. 970 thou. 970 what? 1,000. 970,000. 970,000 as what? As a what? The branch profit there. As the branch profit there. So that's basically how you can be able to generate the accounts. So I want to leave a question. You can be able to try to attempt it. Then when I come, also you'll be able to look at it. We'll be able to look at it as we, in this case, see whether we can be able to. Of course, in this case, there's what we call foreign branches, but it's not within our syllabus coverage, so we don't have to cover it. There are also, you can have foreign branches where we have a branch in Uganda. So you have to do the translation of the branch performance. Then you come up with this kind of what income statements. But now we won't focus on that so much because the examiner basically doesn't call upon, for example, to look into what foreign branches. But in the previous syllabus, it was there. Before they revised the syllabus in 2021, it was there. But we won't go into those kind of, for example, computations because we just focus on what the examiners are, what the CASNEB are calling upon us to be able to prepare you for this exam. So we can be able to look at another example illustration. So you can be able to look at this question for your own practice and exercise. Look at it. Then also when I come in the next class, we'll be able to look at it. Then we can be able to see whether we can move to another area or what will happen. Or what will happen on Friday. What will happen on Friday? We can see whether we can move to another area or what will happen on that Friday. On that Friday. So hope you've gotten an idea of branch accounting and the journal entries. So unaweza jipima nguvu with this question. Unaweza jipima nguvu na this question September. It is September 2015. Question number 3B. Jipima nguvu na hii swali September 2015, question number 3B. Then when I come in the next class, we'll also be able to look at it. Then we can see whether we can be able to move to another area. I don't know if there's any question. You can be able to ask a question. You can be able to ask a question because I can see it is 7:58. It is 7:58. I can see Dennis is saying, is it 970 or 1 million? So the others, what are the others getting? What are the others getting? What are the others? What are the others? Ikapel gets 970. Another person. Joyce gets 970. So the majority have it. The majority have it. It is 970. The correct answer is 970. Maybe you need to be able to check your entries. There must be an entry you haven't been able to capture properly. Because branch expenses is 500,000. Bad debts written off is 20,000. Discount allowed is 30,000. Cash sales stolen is actually 15,000. Goods stolen is 24,000. So Dennis, please check. There must be one of the entries there you haven't been able to capture. Maybe you've missed out on one. The one that is 30,000 is which one? This one for discount allowed. It means you haven't been able to put that one, Dennis. So I can be able to see hope. So unless you are told, they can be able to tell you. Maybe in this case, the returns were basically, in this case, with regard to what? With regard to the cash sales, that's when you can be able to recognize them under sales. But if the examiner is silent, you assume they are basically among us what the credit sales. The credit sales. You assume they are basically among us what the credit sales. The credit sales. You assume they are among us the credit sales. Remember, under normal circumstances in our business, when you are selling on cash basis, the customer is normally there. He's there, he's giving you the cash as he takes the goods. So you can be able to, for example, in this case, just return at that point in time before you even pays for the price, before he even does what pays for the price, before he even does what pays for the price. So that's basically what will likely end up having to do what to happen. So if they are silent, then in this case, it will be under the credit sales. It will be under the credit sales. It will be under the credit sales. That is what I'm trying to say, or hope you've been able to get the point. Hope. Which question iko kwa board? So awoni akideniza awoni. Well, it is September 2015 question number 3B. September 2015 question number 3B, Dennis. September 2015 question number 3B. Try to attempt it. Try to attempt it. It is on branch accounts. Branch accounts. So branch accounts were late is kwa exam sana, but so you need to know how you can be able to deal with it. Surprisingly, it can come in this setting. You never know. You never know. But published group accounts, you need to wake up singing those topics, because those ones, it is like almost 100% guaranteed they'll be there. Published group accounts, almost 100% guaranteed they'll be there. They'll be there. Then there'll be a question also with regard to what assets, assets and liabilities. There'll be a question coming from that area also, assets and liabilities, published accounts, then group accounts. Then they can be able to pick from these other areas that we've been able to cover. So you need to be very keen about published. Of course, you'll be able to do other questions about published when you start block revision. But just like repetitively revise that topic regarding published. So we have group accounts, then we have the cash flow. I think cash flow you've been able to cover recently. Cash flow is also very crucial. Cash flow is very crucial. It is very crucial, cash flow. Cash flow is very crucial. Yeah, so I think we can end there. So let me end there. So let's catch up in our next class. So see you next time. Have a good night.